Ven, I say let's move on because I want to go back to one of our other stories this morning, which is around money going into havens, money going into oil as a result of other US media talking about what could happen between Israel and Iran. And the gold price has jumped on the back of that. It's traded as a haven. But you argue this morning that gold's outperformance, its days of outperformance are over. Give us the backstory.
Well, our backstory starts really from the third quarter of 2022, Anna. So since then, around then, gold was at $1,600 an ounce. Now it's $3,200 and doing something. So gold prices have nearly doubled in a span of 2.5 years. That is a compounded annual return of 28% using the rule of 72. So that is well above what other risk assets have yielded, the S&P, the NASDAQ even. So the Sharpe ratio is very high because gold has not only gone up, but it has gone down. The drawdowns in that rally have been very little. So which means that the Sharpe ratio, which adjusts for the risk, the volatility risk, is pretty high. And therefore, gold has had an exceptional run. Now, the question is, how long does this run continue? It can't be that an investment keeps returning 28% annual compounded. No one can replicate that performance. Even Warren Buffett would be happy with 15% compounded return. So 28% is way above everything else. So that puts it in perspective. Now, if you look at gold in the long run, what has it returned? It has returned inflation plus about 2%. So that is, in a world of about 2.5% inflation, that is about 4.5%. So at the moment, as we discussed, it's going at 28%. It's not sustainable. So there's going to be drawdowns. At the moment, as you mentioned, there's supportive environment for gold because of Israel threatening to attack Iran and all these geopolitical factors. So I think that, gold has some momentum going into this rally, and therefore I think that the rally can extend in the short term. So we are talking about levels of about 3,600, 3,700 even. But after that, I think investors should brace for drawdowns. And those drawdowns, when they come, they can be vicious. In 2012, gold plummeted like a stone, and gold has that property, intrinsic property, where it is overbought for extended periods, but it's also unloved for extended periods. So that may well repeat itself, which is why I think that, I'm not long-term bullish on gold.
Ven, I've got 30 seconds left. Everybody else is worried about deficit spending, government spending too much. That's not the case for Germany. Where does that safe haven story show up in Germany?
Well, it shows up in bonds and in 30-year bonds. If you look at 30-year bonds, they've done nothing at all this quarter, whereas yields have surged in JGBs, yields have surged in treasuries, and also 10-year bonds. And so, the ECB is going to cut rates. Inflation is already under control. And you get a 230 basis point pickup from hedging the currency risk on bonds. Therefore, what's not to like bonds?